Hello and welcome to The Pitch, brought to you by Livewire Markets. I'm Ali Selby, and today we're very lucky to be joined by Schroders Head of Private Assets, Claire Smith, for insights into how you can buy low and sell high. Thanks so much for joining us today, Claire. Really excited to feature you on the show.
Yeah, thanks, Ali.
Sounds pretty ideal, buying low and selling high. How do you even do that?
So in private equity, when you look at buyout companies, which are quite profitable companies, we sort of segment the market into small, mid and large, as you do in most equity markets. But there's a real difference in private equity investing versus buying a listed company. So you often have to sign a non-disclosure agreement, undertake months of due diligence. There's not publicly available information the way there is obviously in the listed market. So that effort is quite a lot. And when you think about return on effort, a lot of investors are really exclusive in the large cap part of the market, because all that work, obviously, then if you're only writing a small ticket, that can be quite cumbersome. But that's exclusively what we do. So we focus on the small cap part of the market, and because there's less competition, that part of the market trades at a discount to the larger end of the market. So we actually can buy at a low multiple, and then, the plan is to grow that company and then sell it at a higher multiple. So yeah, buy low, sell high.
Why would people focus on the large cap market then?
A lot of private equity investors actually start small, and then as they build their track record, they often want to raise larger funds and write larger tickets, so they start to graduate into the larger end of the market. And that is great for your bottom line, because you can raise a larger fund, charge more fees. Again, that return on effort comes into play, so you're doing fewer deals but bigger deals, but it does come at the sacrifice of returns. So as we've seen, the small cap part of the market outperforms the larger cap part of the market. But there are people who are specialised in that part of the market. You look at the big superannuation funds, some of them are so large now that they can't bother to undertake the work to write a $20 million cheque, for example. So we find with our sort of part of the market that we operate in, we're happy to go down to even a $5 million ticket, and then we typically cap out at about a $100 million ticket. And that's where some of these bigger investors, they start to play. So it's actually not a very efficient way to run your business. So in terms of every time we want to double the amount of money we invest or double the amount of deals we do, we have to double the size of our investment team, so it's not scalable. However, that's the way that we have built our brand, that's the way we've delivered returns to clients, and that's what we're going to continue doing going forwards.
How do you actually improve those businesses?
So we have a few key strategies. So as I mentioned, often family-led or founder-owned businesses are the sort of sweet spot. And we find these can be really good companies with great legacies, but perhaps aren't as efficiently run as they could be. So we're often the first institutional capital. We could help them with internationalisation, particularly you look at a market like Europe, which is very fragmented, lots of different languages, legal restrictions. So we have skills to help them expand there. It could be adding products to their suite. It could be improving operational efficiencies, improving sales, lots of quite easy value creation levers that we can build to take what is a well-regarded but perhaps suboptimally run company and professionalise it into a better company that is then more attractive to a broader range of buyers.
Are there any risks that you think investors should be aware of in public markets? At least there's definitely risks when investing in small cap companies. Is that the same in private markets?
Yeah, you have to look at things like leverage. I think a lot of small cap listed companies are quite heavily levered, and I know there's a lot of sort of zombie companies out there. So we look at things like what's their financing structure, how much capital do they have available, what's their angle in the market. So a lot of normal due diligence. But when you look at, say, the general statistics around buyouts, so typically 1 in 10 private equity buyouts will go bad. Our long-term track record is 3.5% loss rate. So we've actually proven we've got the skills, the expertise to pick those good companies and help grow them, and more often than not, make money rather than lose money.
Well, thank you so much for your time today, Claire. It was awesome to feature you on The Pitch.
Yeah, thanks, Ali.
If you enjoyed that too, don't forget to subscribe to Livewire's YouTube channel. We're adding so much great content just like this every single week.